Good evening. Please come to IAS 21. IAS 21 is called the effect of changes in foreign exchange rates. So this standard is very useful for those entities who have transactions in foreign currency. More and more companies are becoming global companies. So they have transactions with other countries. They sell goods to other countries, they purchase goods from other countries, they borrow money, they lend money, they invest in other countries. Many companies have foreign operations outside their country. For example, they have subsidiary, they have associate, joint venture, branches. So this standard will deal with first how the transactions in foreign currency will be reported in functional currency. Second, if you have foreign operation, how the financial statement of foreign operation will be converted into the reporting entity's functional currency or presentation currency. Then the standard also deals with a situation where your presentation currency is different from functional currency. So how will you convert functional currency into presentation currency? So that is the importance of this standard. It does not deal with derivative contracts because derivatives will be now covered by IFRS 9. So see the introduction of this standard. This standard prescribes principle for initial recognition of foreign currency transaction. So if you enter into a foreign currency transaction today, you have exported goods worth $1,000. Then your functional currency is suppose INR, Indian rupee. So how will you convert it into rupees? Is it right? So this standard deals with that. We'll discuss the rule of conversion. So initially, when you have suppose imported goods, at what rate you will convert $2,000 into your functional currency rupees? If you have borrowed money today, you will get in foreign currency suppose $2 million. So in your books you have to report in functional currency. At what rate you will record it? Then it also deals with subsequent measurement of the items that are denominated in foreign currency. So I had exported the goods. Now on the reporting date, this is still outstanding, still due. Will you report at the same rate or will you report at a different rate? Different rate. So what will be that rate? The standard deals with that. And then what happens when you are using different rates? At the end of the period you will find there is exchange difference. Exchange difference will arise. For example, let us say this you have recorded at 60 rupees per dollar, but on the reporting date the rate is 70 rupees per dollar. So this 10 rupees per dollar difference will arise. What will be the treatment of that exchange difference? Will it be transferred to P&L account or will it be transferred to OCI? Will it be capitalized? No. This standard does not give any scope of capitalization of exchange difference. Okay, will you defer it? The answer is again no. Either P&L account or OCI. Otherwise, there is no third choice now. Also provides the guidance as to the manner in which foreign operations would be incorporated in the reporting entity's financial statement. Now suppose you have foreign subsidiary. To prepare consolidated financial statement, I need to convert the foreign operations financial statement into the reporting currency of the CFS. that is also taken care of by this standard. Foreign operation can be a foreign subsidiary, foreign associate, foreign JV. So basic consolidation rule will be followed as per respective standard. For example, for subsidiary, the basic rule of consolidation will be as per IFRS 10, and for this other two standards, it will be IAS 28. But in case if there are different currencies, subsidiary's financial statement is in dollar, parent company is in rupees, then this standard will apply for conversion. Okay, in this chapter we are not going to do the consolidation, we will only learn the rule of conversion. We will only learn the rule of conversion. Consolidation you will study in IFRS 10 for subsidiary and IAS 28 for associate and joint venture. Some companies may have financial statement presented into presentation currency, which may be different from functional currency. Functional currency depends on your transactions, cash flows, okay, the way the entity operates. So while choosing functional currency, one has to see the primary economic environment in which it operates. Whereas in case of presentation currency, it is purely entity's choice in which currency it wants to present its financial statement. So when the functional and the presentation currencies are different, then the standard will guide you how to convert functional currency into presentation currency, and what will you do with the exchange differences, if any. Now next is some basic terms that we'll understand. What is exchange rate? What is exchange rate? Exchange rate is the ratio of exchange of two currencies. For example, if I say INR 70 per USD, this is exchange rate between rupee and US dollar. 1 US dollar is equivalent to 70 rupees. In this standard, we will deal with several types of exchange rate. For example, the standard will talk about closing rate, spot rate, average rate. So I have brought all the three definitions at one place only. Closing rate is the spot exchange rate at the end of the reporting period. That is called closing rate. Rate of exchange at the end of the reporting period. Suppose your reporting period is 31st March 2000 dash. Then in that case, you have to find out from the foreign exchange market what is the rate of exchange on this date. That rate is closing rate. Many items in the SOFP will be translated using closing rate. Okay, so closing rate is very important because in SOFP, we will discuss in next 2 minutes, all monetary items are translated at closing rate. Even non-monetary items which are measured at fair value, they are also translated at closing rate in case if the fair value is determined at the end of the year. Okay, so that is the importance of closing rate. Then the standard talks about spot exchange rate. What is spot exchange rate? Exchange rate today. Rate of exchange for immediate delivery is called spot rate. So suppose I go to a bank today and I ask, I want to buy $1,000. How much will you charge? The bank says 72 INR per dollar. You give me 72 rupees, I'll give you $1. That is called spot rate. What is the importance of spot rate? Importance of spot rate. all forex transaction, the standard says all foreign exchange transaction will be initially recorded. Initial recognition ideally is spot rate. So whenever a transaction in foreign exchange, foreign currency takes place, the best rule is, the golden rule is, it must be converted into functional currency at the spot rate of exchange on the date of transaction. Of course, there are exceptions. You can apply average rate also. Okay. And then what is average rate? Average rate is the average rate of a week, month, etc. If there are no major fluctuations, if there are no major exchange fluctuation, as you know, exchange rate keeps fluctuating. If there are no major exchange fluctuation, then average rate can be used. Okay, for similar transactions. If you are exporting on a regular basis, every day you are exporting goods to US customer, then what you can do, you can take the average rate of that week and all the sales transaction, all the export transaction of that week, you will convert at average rate. Is it right? Subject to average is not volatile. Rate is not very volatile. Now, they have not given any particular range about volatility. It is your judgment. So you can take the rate 63, 63.50, 63.80, 63.90, 64, 63.80, and then divide by, say for example, 6. This gives you average rate of a week. All similar transactions apply average rate. Okay. All similar transaction apply the average rate. If average is realistic, there is not too much of fluctuation. What if there are too much of fluctuation? Then we'll take the spot rate on the date of transaction. Exchange difference is a very tricky issue in this chapter. What treatment will be given for exchange difference? Suppose there is a transaction on 1st March 2020. Year ending date is 31st March 2020. The transaction was actually settled on 30th April 2020. So let us put some number for understanding. Export of goods on this date, $1,000. Rate of exchange 70. Here the rate of exchange 71. Here rate of exchange 72 INR per dollar. Okay. So what will be the accounting treatment? First, when we sell, we'll record the sale transaction. Like in schools, we used to write debtors account debit to sales account. So you'll first apply this spot rate, 70,000. But this customer has not settled so far. He is appearing in the balance sheet. So I will apply 71 to value this customer. He has already been valued at 70. So I have to just increase the value by 1 rupee. Entry. Debtors account debit to. Now what is called exchange difference. 1 rupee into 1000. 1 into 1000. This is called exchange difference. Now when he makes the payment, the rate is 72. So I will receive 72,000. I will de-recognize debtors, but debtor is 71,000. Again there is a difference. So this again we will call exchange difference of 1000. Okay. So what is exchange difference? When the same unit of foreign currency 1,000, 1,000, 1,000 is translated using a different exchange rate, it will give rise to exchange difference. So exchange difference is the difference resulting from translating a same number of unit of foreign currency into another currency at a different exchange rate. What is the treatment of exchange difference? This student is saying P&L account, but not always. So there are two treatments, mostly P&L account, general rule, but in some circumstances, then it will go to OCI also. So till the end of this chapter, we will discuss which item will go to P&L account and which item will go to OCI, right? So that we'll discuss at the respective places. Now we'll come to foreign operation. What is foreign operation? Foreign operation is an entity which can be a subsidiary, associate, joint venture or branch of a reporting entity, the activities of which are based. They may be incorporated in the same country also, but the activity must be based or conducted in a country other than those of reporting enterprise, or the activities of which are based or conducted in a currency other than those of the reporting enterprise. So it's either activity or currency or both are in a different country other than those of the reporting enterprise. So what is the importance of foreign operation? In the process of consolidation, we need to convert the financial statement of subsidiary, associate, joint venture or branch. If their functional currency is different from the functional currency of the reporting entity, then this will be required to be converted into the functional currency of the reporting entity, and that time again will require the rule of conversion. So now come to question number 1. Close the book. Answer is printed. Only think and answer. Candid International, which is located in France, has a subsidiary Candid Inc. which is situated in UK. Whether Candid International has foreign operation? Yes, a subsidiary located in a different country other than those of the reporting entity is a foreign operation. Okay. So in this case, Candid Inc. conducts its business in UK, where the national currency is pound. So country is also different, currency is also different. Whereas Candid International conducts its business in France, where the national currency is euro. Hence, it is said that Candid International has foreign operations. Next definition, currencies. So in this chapter, we will have 3 currencies. Which 3 currencies? Functional currency, presentation currency, foreign currency. All are described in the diagram below. Functional currency means the currency of the primary economic environment in which the entity operates. So this is a subjective statement. Currency of the primary economic environment in which the entity operates. Okay, so this is one Indian company. Now how the problem can arise? See, Indian company, it is exports to USA. It imports from Japan the component, okay, that is required for manufacturing. Then raises funds in euro It has raised funds from Euro, some European country like Germany, France, they have raised money. Then labor and overhead, they incur in INR. Is it right? So you can imagine the problem. What will be the functional currency of this entity? INR. Why? Because labor and overheads are incurred. But don't you think your revenues are also an important factor to be considered? So this may require judgment at some time. Although normally what this Indian company normally would do, it will choose normally its home currency as functional currency, because many transactions they do in functional currency only. Payment to labor, overhead, taxes, okay. And even when the dollar is earned, it is brought into India and deposited in a bank. So the income is also retained in INR. Income is retained in INR. So many factors will be seen. And if after analyzing all these factors, you may conclude that INR is the functional currency. Functional currency is not a matter of choice. Functional currency is to be determined after considering several factors. And if the several factors points out it is INR, then it is INR. Then you can't say, no, I want dollar. Then dollar you can choose as presentation currency, but not as functional currency. Functional currency is not a matter of choice. It is a matter of determination. What is foreign currency? Is a currency other than functional currency of the entity. So in case if you have chosen INR as functional currency, then dollar will become foreign currency. But if you have chosen dollar as functional currency, INR will become the foreign currency. So what is the third currency? Presentation currency. Presentation currency is the currency in which financial statements are presented, right? Most of the times functional currency and presentation currency would be same, but generally when we prepare group financial statement, subsidiaries functional currency will be different from the presentation currency of the parent. So that time we will require to convert the subsidiaries functional currency into the presentation currency of the parent. So most of the group companies who are in different jurisdiction, different geography, what they do, they prepare the financial statement in a presentation currency, which is used by the parent company for consolidation purpose. Or maybe your country's legal requirement is that you must present in a particular currency. Like in India, you have to give one financial statement in INR. Do we have a choice? Do you know? Suppose I say my functional currency is dollar. My export is in USA. Import is from USA. Funds are raised in USA. Payment to labor is also in US dollar. Income is also retained in a US bank account. Then it is an Indian company, but functional currency will become dollar. But still that company will be required to present its financial statement in INR because of a lot of local requirements. Yes. Now we'll come to next very critical definition called monetary item. What is monetary item? Monetary items are units of currency held. Units of currency held means cash and bank. Okay. So all currencies and bank account are monetary item by definition only, and assets and liabilities. But which assets and liabilities? Those which are to be received or paid in a fixed or determinable number of units of currency. Now again, one has to apply his judgment carefully and check whether an asset or a liability is a monetary item or not. Like example will help us to understand. Cash is a unit of currency. Bank, receivable. Why receivable is a monetary item? Because we have to receive a fixed amount of money. Say for example, I have a dollar 1000 debtor. So this is a fixed amount. If it delays by more than 1 month, interest at the rate of 18% per annum will be charged. But even that is determinable. Even the amount I am going to receive is fixed or determinable. Payable, same example. Loan. What about pension and other benefits to be payable in cash? Pension and other benefits to be payable in cash is again fixed or determinable. Provisions which are to be settled in cash are monetary item. Investment in government security. Investment in government security, is it a monetary item? That also write down as an example in that line. Investment in government securities. Because government will give you a fixed amount of interest and a fixed redemption amount on maturity. So therefore it is received or payable in fixed number of units of currency. Then what about these items on the screen? So to understand monetary item, we should also understand what is a non-monetary item. Non-monetary items are those assets and liabilities item which are not monetary item. Which are not monetary item. Example, property, plant and equipment. Just check whether in property, plant, equipment is the amount received or paid is fixed. Is the amount to be received or paid is fixed or determinable? Now see, these are the examples of non-monetary items. Property, plant, equipment. Is there any fixed or determinable amount? Tomorrow if I sell, you get a different amount. 1 month down the line if you sell, you may get a different amount. But from the debtor I am going to receive 1000. Plus if there is an interest, that is what I will receive. Intangible asset. Same reason. Investment in equity securities. Not in government securities, because here the amount is not fixed or determinable. One more important issue, prepaid expenses. Monetary or non-monetary? Non-monetary. What you are going to receive? Services. So there is a debate on this. Advance to supplier, monetary or non-monetary? Non-monetary. Because you are going to receive goods. Goodwill, non-monetary. So for this item the rule will be different. For monetary item the rule of conversion will be different. Now next definition is net investment in foreign operation. Net investment in foreign operation is the amount of the reporting entity's interest in the net asset of that operation. So it is basically investment in equity instruments, long-term loans whose repayment is not planned. So it is as good as investment in equity only. That is net investment in foreign operation. Now this standard has some separate rules for net investment in foreign operation. Yes, at some places OCI. So therefore it has been discussed separately, because here these are generally very long-term investments. These are very long-term investment in foreign operation. There is no repayment planned in the near future. So the purpose of discussing it is that if it is proved that it is a net investment in a foreign operation, then in that case, some rule of translation is different here, right? Now we'll have to first understand quickly how to determine the functional currency. Foreign currency transaction of the entity are required to be recorded in the functional currency of the reporting entity. Functional currency is identified with reference to primary economic environment in which the entity normally operates. This is what the standard says. Now, I will quickly summarize factors which influence the functional currency, indicators. So these indicators are of two types: primary indicator, additional indicator. Primary indicator means these are the main indicators. First, use main indicator, and from the main indicators, if you can arrive at some kind of conclusion, then that will be the functional currency. So which are the main indicators? Those which influence revenue. The main indicator is the first one, those which influence revenue. That is the currency in which you generate the revenue. Okay. And second primary indicator is the cost, revenue and cost. Which is the currency in which you generate your revenue and which is the currency in which you incur your majority of the cost like labor, material and others. Or you can look at the additional indicator. If you're not getting a very clear picture, look at the additional indicator like those currencies which influence the pricing decision, currency in which company raises the finance, or the currency in which receipts from operating activities are normally retained. Diagram looks simple. Problem is there will be conflicting indicators. Revenue may come from USA, so US dollar. Cost is incurred in India. Okay, then funds are raised from Europe. Funds are retained in Switzerland, Swiss bank, CHF currency. So then the question will be, what would be your functional currency? So use this guideline, use your analysis. In case if you're not able to arrive at some conclusion, then you have to apply your judgment and then choose a currency as functional currency. Okay. Practically speaking, most of the companies uses which currency as functional currency? Home currency. Is it right? So that they don't have the trouble of converting foreign currency into functional and then functional into presentation. But the standard says it is possible that we may have foreign currency, functional currency and a presentation currency also. So primary indicators are those which affect revenue. The currency in which the prices for goods or service, that is revenue, of the entity are denominated and settled usually influence those prices. There may be cases where the currency of the country whose regulatory environment and the competitive forces in a particular market may determine the prices of goods or service. So under this paragraph, we have to see which currency influence the price and therefore revenue. Price may be influenced by the currency. Like many countries in the world, nowadays I find prices are quoted in dollar. Is it right? So if an Indian party is talking to a Emirates party, Dubai party, they don't speak in rupee that this pen is 200 rupees, this pen is 20 dirham. They say this pen is 500 or $5. Is it right? Sometimes the regulatory requirement will be there, sometimes the competitive forces may force you to choose a particular currency for pricing purpose. So that will influence your revenue also. Second factor is cost. Where, in which currency your costs are incurred. Which are the major cost of a company? Material, labor, overheads. And since many companies find their most of the cost are in their local currency only, their functional currency becomes the local currency becomes their functional currency. The currency that influences these significant elements of operating cost is functional currency. Then in additional indicator, we can check the currency in which funds are raised, currency in which equity shares are issued, preference shares are issued, debt is issued, loan is taken. That is an additional indicator. Then fourth indicator is receipt from operating activities are retained. In which currency once you generate the operating receipts, it is retained. So that can be an additional indicator of functional currency. So now I will check whether you are listening or not. Solve. Question number 2. Don't read the answer. Senorita Pastures is a Spanish entity. The currency that mainly influences its selling price for its goods and services is euro. Okay. The competitive forces and regulation of Spain mainly influences the pricing policy of Senorita Pastures. Senorita Pastures mainly pays for the labor in euro, but pays for the import of raw material and other material, which is in pound, which is 80% of your total expense. Required. Determine the functional currency of Senorita. So don't you think there are conflicting indicators now? Revenue and pricing is in euro. Labor is also in euro. But material and other expenses are in pound. So which currency would you choose as functional currency? Pound or euro? So the answer would be euro, because revenue 100% they are mentioning it is in euro, or nothing is mentioned, so we can assume revenue is in euro. Even the pricing decisions are based on euro. 20% of your cost is also in euro. Of course 80% cost is in pound. But if I have to choose one of the two, which would be the functional currency of this Spanish entity? Their own currency euro, or that pound which is the currency of Great Britain, euro. So how will you write the answer? That is a strategy. The currency that mainly influences the selling price for goods is euro. The competitive forces and regulation of Spain mainly influence the pricing policy, that is again euro. However, 80% of total expenses is incurred in pound, which indicate that pound can also be considered as a functional currency. In this case, because there are conflicting indicators, the management has to decide which currency best reflects the underlying transactions, events and conditions that are relevant to it. Okay. Once determined, the functional currency can be changed only when there is a change in underlying transaction, events and conditions. The standard has one more paragraph later, change in functional currency. Can we change? Yes. But you can change only if the underlying transactions, events, conditions change significantly. Okay. Like in this example, suppose your revenue also comes from pound. Later, cost is already in pound. Then one can change the functional currency from euro to pound. But that discussion later. One more question, number 3. IAS Foundation International operates in Germany. It has raised its capital in euro. Germany's currency is euro. Incurs all expenses in euro. Expenses are in euro. Funds are raised in euro and is determined by the laws of the Germany. 80% of the sales revenue comes from France, France is also euro. I don't know why they have given this question. Earlier the currency was different. Germany had mark, France had franc. Now both country uses euro. So the answer is euro. There is no need to check anything. Still, while answering, you have to write that AS Foundation International operates in Germany and earns its revenue from France. So functional currency could be currency of France or Germany, because both are quite significant. 80% revenue is a significant number. Hence, however, as the currency of both these countries is euro, management need not consider the factors while determining the functional currency, because in either case the functional currency would be euro. So this is about reporting entity. Now we'll discuss about the functional currency of foreign operation. Okay, what would be the functional currency of the foreign operation? So the standard says functional currency of the foreign operation can be same as that of the reporting entity, or it can be different from the reporting entity. So they have given you some indications again, and based on this indication we will choose the functional currency of the foreign operation. Okay, so point number 1, paragraph 7, the degree of autonomy of foreign operation. What is autonomy? Autonomy means free, freedom, independence in decision making. Okay, so that is called autonomy. What can be autonomy with respect to foreign operation? That is, they will decide in which currency they should sell, at what price they should sell, to whom they should sell, from whom they should buy, from where they should raise funds, to whom they should hire as employees, what should be their marketing strategy, distribution strategy. So if the decisions relating to operational and financial management, generally if they can be taken by the foreign operation directly itself, they are not dependent on the reporting entity for decision making purpose. Okay, then it will have a different functional currency. Then its functional currency could be different from reporting currency, reporting entity's functional currency. But if it is dependent on foreign reporting entity for everything or most of the things, then it is nothing but an extended arm of the reporting entity. Extended arm means you are just carrying out the activity of reporting entity just in a foreign country. It is as if the reporting entity itself is present in the foreign country, although for legal purposes they have created a separate entity, but it is all the reporting entity working there. So in that case, the functional currency of foreign operation will be equal to functional currency of the reporting entity. Is it right? So what is the summary of this paragraph? If it is independent, functional currency can be different. If it is dependent on reporting entity, then functional currency same as reporting entity. Functional currency same as reporting entity. Second criteria, quantum of transaction between reporting company and foreign operation, reporting entity. Transactions can be low, transaction can be high. If it is low, functional currency will be different from functional currency of reporting entity. But if the volume of transaction is high, then you can say same as reporting entity. Functional currency will be treated as same as reporting entity. Many times what happens, the reporting entity will, I will draw the diagram here, will sell its goods to foreign operation, and then foreign operation will sell those goods in the local market in that foreign country, and then whatever money they collect they transfer to reporting entity. If this type of arrangement is there, then the functional currency of this foreign operation, which is just an extended arm of the activity of reporting enterprise, will be treated as same as reporting entity. But one has to apply judgment. In case if it is not 100%, then judgment. Third is whether the cash flow generated in foreign operation affect the reporting entity's cash flows. Reporting entity, foreign operation. So reporting entity has instructed the foreign operation that whatever cash flow you will generate, don't keep it with you. On periodic basis, you remit the cash flow to the reporting entity. What is the relationship between two entities here? Again, it is more like an extended arm. So if reporting entities cash flows are affected by the cash flow generated by foreign operation, then it is a case of functional currency of foreign operation equal to functional currency of reporting entity. In other case, the functional currency can be different. Point number 4, whether the net cash flow generated by the operating activities of foreign operations are self-sufficient. Whether the net cash flow generated by foreign operating activities of foreign operations are self-sufficient. Now, how do you check this now? So, whether the foreign operation depends on reporting entity for funds requirement. Depends on funds requirement. It is not able to meet its operating activity from its own funds generated. Then functional currency of foreign operation is equal to functional currency of reporting entity. In other case, that is, if it is self-sufficient, then the functional currency can be different from functional currency of the reporting entity. Now we'll start some problem. So keep all these factors in mind which we discussed: autonomy, cash flow, dependency on funds, quantum of transaction. Open book, okay, and answer. AS Foundation Global, a British entity, has a subsidiary in Bermuda. That is another country. The subsidiary sells its products to subsidiary sells all its products to AS Foundation Global. Means your quantum of transaction is very high. Determine the functional currency of the subsidiary. So if you look at the factors to be considered, first factor is degree of autonomy, which we don't know right now. But second point is that quantum of transaction is very high. Does it fit into that? Yes. So the answer would be, based on whatever limited information given to you, that functional currency of the subsidiary will be same as the functional currency of this parent company, which is a British company, so it will be pound. Is it right? So answer I have written. In this case, the proportion of transaction which the foreign operation have with AS Foundation Global, that is reporting entity, is high. Hence the functional currency of this subsidiary will be pound, which is the functional currency of the reporting entity. IAS Foundation Global, assuming it satisfies the other conditions also. That means other conditions are not conflicting with this condition, because information given to us is very limited. Next question below that, IAS Foundation Global, an entity incorporated in Germany, sells 80% of its product through its branch office which is situated in China. The head office at Germany depends upon the remittances made by its branch office in China to finance its normal operating activities. The Chinese branch is able to readily remit cash to its head office. Determine the functional currency of the Chinese branch of IAS Foundation Global. Now here we see that point number 3, whether the cash flow generated in foreign operation affect the reporting entity's cash flow. So this line says the head office at Germany depends upon remittance made by its branch office in China to finance its normal operating activity. And second, there is no restriction on this Chinese branch to remit the cash flow also. So that means the cash flow are integrated. So what will be the functional currency of this Chinese branch? Same as German entity. So in this case, the functional currency of the Chinese branch of IAS Foundation Global is euro. That is the national currency of Germany, because the cash flow of foreign operation directly affect the cash flow of IAS Foundation Global, and there is no obstacle in the remittance of cash by the branch to the head office. One more question. Surefire. What is parent's name? Surefire Inc. is an Austrian entity whose functional currency is euro, has a subsidiary Fireaway. Surefire has a subsidiary Fireaway in UK. Following information is available about Fireaway company. Ordinary share capital is $20,000. Loan from bank, pound 20,000. So this company has raised share capital in pound, has raised loan in pound. But you have to read the full sentence to answer. As it has not commenced its operation, it depends upon Surefire Inc. for repayment of the bank loan. So this line will give you a hint whether this is self-sufficient in generating funds from its operating activities. The answer is no for the time being. So it depends even on the parent company to repay the installment of the bank loan. So it means it is not self-sufficient. If there is a dependency on the reporting company for funds requirement, then the characteristics is that of, you can say, a dependent entity, and therefore the functional currency of the subsidiary is same as that of parent reporting entity. And what is the reporting entity's currency? Euro. How do you know euro? Where it is printed in the question? First line. Euro. Under these circumstances, even if Fireaway company has an equity capital of 20,000 pound, its functional currency is euro, the functional currency of Surefire, because it depends on Surefire Inc. to repay its dues. Question number 7. Yaber GmbH is a German entity which makes machine tools. It has a subsidiary in Singapore called Shape Inc., to which it sells some of its finished goods. Shape Inc. is the authorized dealer of Yaber GmbH for the whole of Southeast Asia and engages in no other activity of its own. Determine the functional currency of shaping. Euro. Why? It has no other. That means 100% of the transactions is with the parent company. So there is a high quantum of transaction with the parent entity. So it seems like just an extended arm of the parent entity. It is like a sales office. And through the sales office, they are selling the customers in Singapore. So such type of branch subsidiaries are nothing but an extended arm, and you can easily treat the functional currency of this Singapore entity as the functional currency of German entity, which is euro. So how do you write the answer? In this case, Shaping only resells the goods manufactured by Yaber throughout Southeast Asia. It does not do any value addition, nor it is engaged in any other independent activity of its own. Hence, Shape Inc., the foreign operation of Yaber GmbH, is just an extension of Yaber GmbH, so the functional currency is euro. Assuming that other factors also indicate that euro is the functional currency of Yaber GmbH, not the Singapore dollar, that is the currency of the country in which Shape Inc. operates. Oh, what if there are conflicting indicators? These questions were designed which were biased, because by reading the problem one can come to a conclusion easily. But there will be conflicting indicators. Okay, and then it becomes the management's judgment. They have to sit down, analyze, and then determine which is the functional currency. So there is no scientific method. You do this experiment and this is your functional currency. Like this example will demonstrate how a situation can be so conflicting. There can be more than one answer in this question. Nice Corp is located in England and its functional currency is pound. It manufactures electronic goods and sells some of its finished products to Flash Inc. in France. Flash Inc. is an associate of Nice Corp and its total revenue is split as follows. Percentage of revenue, sale of goods purchased from Nice Corp, sale of other goods. Now see, the revenue is 35% is sale of goods purchased from Nice Corp, and 65% revenue is from sale of other goods. What is the functional currency of this Flash Inc.? If you look at the numbers only, then 65% seems to be higher. But 35% cannot be said to be a small percentage also. Okay, the standard does not say more than 50%. So this is a conflicting indicator. But this question has not given us detailed information. So then you have to apply your judgment and come to a conclusion. So it says that in this case, Flash Inc. operates with a significant degree of autonomy, because the share of goods from Nice Corp in total revenue is only 35%, which means at least we can conclude they have got sufficient degree of autonomy. They are allowed to sell goods manufactured by other parties also, which is 65%. Hence the functional currency can be euro, that is the national currency of France, assuming other factors also indicate euro is the functional currency and not the pound. But what the author says, before taking a decision, management should also consider other factors, because you are given very limited data. The data is biased in favor of euro. One should also consider following factors: which currency influence the revenue of the entity, which currency influence the pricing policy, which currency influences the cost, in which currency finance is generated, in which currency the receipts retained by the entity. The answer of these questions are not available in this given case study, yes or no? Now, they could have also given they depend on the head office for their funds requirement. Then immediately your answer can change. Okay. They have to remit all the cash flow generated to the parent entity. Again, your answer can change. So one has to examine all the facts and circumstances and then come to a conclusion. If answer to most of this question indicate euro, then it will be the functional currency of flash ink. However, if there are conflicting indicators, management has to decide which currency best reflects the underlying transaction events and conditions that are relevant to it. So sometimes judgment will be required. Which currency best reflects the situation of that entity? So after this long discussion on how to identify functional currency, now we'll come to the accounting part. Just one more minute. Presentation currency. The currency in which financial statements are presented. Now this is a choice. The standard permits an entity to present its financial statement in any currency. Now here there is no condition attached. You decide. You want to present in euro, pound, dollar, you can. You can present in different currency both. Your standalone or separate or consolidated financial statement. We have no say in that. We can only guide you. We can only guide you how to convert your functional currency into presentation currency. The standard stipulates conditions relating to translation of the amounts to be complied with when an entity presents its financial statement in a currency other than functional currency. So one situation when we will require this is in standalone statement. Second, we will require it in the case of consolidation, or where the functional currency of the component entities means subsidiary, associate, joint venture, branch. When the functional currency of subsidiary, associate, joint venture and branch that form a part of consolidated financial differ from the presentation currency. So that time we require this, because most of the time you will find the functional currency of foreign operations most of the time is different from the presentation currency of the reporting entity. So that time we will require to convert the functional currency of subsidiary, associate, joint venture, branch into presentation currency. Now come to accounting part. Keep calculator ready. Reporting of foreign currency transactions. So what I have done on this diagram on the screen, we have made a summary of what you have to do. This is enough. This is for transactions entered into foreign currency by a reporting entity. Transaction entered into foreign currency by the reporting entity itself. So whenever your foreign currency is different from, or your currency is different from functional currency, this rule will apply. First come to left side. Initial recognition. Option 1. Spot rate on the date of transaction. Okay. Alternatively, average rate may be used. If there is no significant fluctuation. Underline. I have written that in bold. If there is no significant fluctuation. Initial recognition. Paragraph 10. Above. So spot rate will be required for converting foreign currency into functional currency. If similar transactions are taking place regularly, then for the entire week or entire fortnight or entire month, calculate the average and use that one single average rate for all the transactions of similar type for that week, fortnight, or month. Is it right? But take care that the rates are not too much fluctuating. So this is about initial recognition. What about subsequent measurement? Now we may enter into transaction here, but the transaction may not be closed when we go to the year ending date, reporting date. Debtors may be outstanding, creditors may be outstanding, loan may be outstanding. Okay. Then you might have purchased a fixed asset in foreign currency. You may have purchased inventory in foreign currency. So those items are now appearing in your SOFP. So what will you do? Divide first them into two categories. Divide assets and liabilities into two categories, monetary and non-monetary. Non-monetary also you divide into two categories. Those which are carried at historical cost. Those which are carried at historical cost, like cost model of valuation of property, plant, equipment and intangible asset. And those which are measured at fair value. Okay, so now see the rule of conversion. Monetary item at closing rate. What is closing rate? Rate of exchange on the reporting date. Unless it is unrealistic. Unless it is too unrealistic, then in that case we can take a more realistic rate. Although that is not mentioned in the standard and not required for you, but it is if it is too unrealistic on the last date of the year, then don't take that rate. Okay, take a realistic rate. Then what about non-monetary item which are measured at historical cost? Give me three examples. One is PPE, cost model. Investment property also, cost model. Intangible asset, cost model. Inventory, cost, or NRV, whichever is lower. So cost will be calculated using this concept and NRV will be calculated using this concept. Is it right? So which exchange rate you will apply? The exchange rate at the date of transaction, means historical rate only. So if this property, plant and equipment was purchased on 1/5/2010, so whatever rate you had applied on that day, same rate will be applied today also when you are preparing the financial statement on 31st March 2020. Okay. Same thing for investment property, but or intangible asset or inventory. And then non-monetary item when fair values are determined. When fair values are determined, you will take exchange rate of that day. Say for example, you are following revaluation model for property, plant, equipment. Then the date when revaluation is done, on that day, whatever is the exchange rate will be taken. Okay. Or another example is inventory measured at NRV. Financial assets, because most of the financial assets are measured at fair value only. So the date when fair values are determined. In most cases, the fair value is determined on the reporting date itself. Like NRV calculation is done on reporting date. Fair value of financial instruments are also done on reporting date. But revaluation of property, plant, equipment could have been done a year back, could have been done 6 months back. So in that case, that rate will be taken. Okay. So now first we'll do some practice. Chapter is important because in a case study problem, big problem, they will give you some adjustment which is dealing with foreign currency transaction. Oh, the answer is also given, it seems. But we will check whether it is right or wrong. X Limited has certain item of property, plant, equipment purchased and located abroad. These are depreciable asset. These are depreciable asset, and depreciation is charged on straight line basis. The asset is purchased on 1,415 for US dollar 80,000, having useful life of 20 year and residual value of 2%. So what will be the depreciation on straight line basis in US dollar terms? 80,000 minus 2% divided by 20 years. Dollar how much? 3920. Okay. There is a related payable of dollar 60,000 which was paid on 31st July 15 only. How should the foreign currency denominated PPE and related payables be translated? Exchange rate is given on the date of purchase, on the date of payment to creditor, and then at the end of the year. Is it right? So first you have to answer at what rate this asset will be initially recorded. 61.4193. So you will first record this property, plant, equipment at 80,000 into 61.4193. Just check this number. Is it right? 4913544. Very good. And then on this will provide depreciation. Just check the date printed in your notes. If it is something different, then correct it. 31st March 16. Depreciation. You have calculated 3920. What about the rate? If you are following historical cost method, the depreciation will also be provided on this amount only. So same rate, 61.4193. Multiply, check. So depreciation charge will be, check the answer, 240764, tick mark. Then the fixed asset will appear in the SOFP at 76020. Check the balance. Multiplied by 61.4193, 4672, 780. So this is the accounting of PPE. When you buy fixed asset to bank, depreciation to PPE, and this amount will appear in SOFP. Now come to the liability. On 1/4/15, change this date 31st March 16, these two dates. 1/4/15, the credit availed was $60,000. Same rate, 61.4193. Multiply. Check. Is it 3685,158? And then when you settled it on 31st July 15, the rate was 62.4135. Just check 60,000 into 62.4135. 37,44,810. Now, is it exchange fluctuation gain or exchange fluctuation loss? Because your rate has moved up and you have to pay. So, therefore, you ended up paying 59,652 more. Okay. This is one way of presentation. You can also pass journal entries if you want as homework. No, you don't want. Why? Easy. Where the 20,000 has gone, that you assume paid in cash in the beginning, down payment. Okay. Anyway, such questions have neither been asked nor will be asked. exchange difference now. Why do exchange difference arise? Exchange difference arises because initially we record the transaction at some exchange rate, then subsequently on the reporting date at some other exchange rate, and when we finally settle those items, that time we use another exchange rate. So between initial recognition to subsequent recognition the rate changes, or between initial recognition to final settlement the rate changes, and they give rise to exchange difference. Where should exchange difference be transferred to? Such differences are recognized in profit and loss account usually, but not in all 100% cases. The standard is little complicated when it comes to treatment of exchange difference, because sometimes they will ask you to transfer to OCI, but those are some special cases. So wherever it will come, we'll underline, and then maybe you can make a summary at the end. Following transactions will be routed through OCI, remaining transactions P&L account. So we will check tomorrow who will prepare a nice summary. Okay, you will prepare. Okay, such differences are recognized in profit or loss in the period in which recognition, reporting or settlement takes place, but not every time. Recognition of exchange difference in non-monetary item. So that first paragraph after 11 number point is applicable to monetary item. So for monetary item, P&L account, non-monetary item depends. In case of non-monetary item depends, where do we recognize the gain or loss on such non-monetary item? Like for example, in case of revaluation gain, we record in OCI. So the corresponding exchange difference will also be recorded in OCI. So next two lines I have written there, that if the gain or loss is recognized in OCI, the related exchange differences are also recognized in OCI. For example, if revaluation gain or loss is recognized in OCI, the exchange difference is also recognized in OCI. If the gain or loss on non-monetary item is recognized in profit or loss, like FVTPL asset. Which asset? FVTPL asset. Then the exchange difference is also recognized in profit or loss. Now solve this question. This question is, some space is kept blank for you. On 13th April 2014, X Limited purchased raw material on credit from a US supplier for USD 10,000 at rupees 60.3520 per US dollar. Balance of the trade payable was settled on 30th July at 59.5625. Show the accounting entries. Directly come to that accounting entry part. First we will record the purchase on 13th April. Purchases account debit to trade payable. Multiply 10,000 USD into 60.3520. 6,03,520. Write down. And write down here also 6,03,520. Is it right? Then you come to the payment date. On the payment date, the rate was 59.5625. So trade payable account debit 6,03,520. Close this account because the bill is fully settled. Yes or no? And to exchange gain and to bank. So first you write down to bank 10,000 into 59.5625. 595,625. And to exchange fluctuation gain, balancing figure check. Is it 7895? Are you checking? And what about this exchange fluctuation gain? Next entry at the end of the year, you will transfer it to profit and loss. exchange fluctuation gain account debit to P&L account. This is a monetary item. Trade payable is a monetary item, therefore we will transfer to P&L account. One more question quickly in the same place. X Limited sold goods on 17 June for euro 15,000. Spot rate is 81.2184. Trade receivable was collected on 17th August. Spot rate is 81.4703. Show the accounting entries. So first we will book the sales. Trade receivable account debit to sales account. Take your calculator. Don't copy the answer. Type on your calculator 15,000 into 81.2184 equal to 12,18,276. Correct. And then you receive the payment. When you receive the payment, the rate is 81.4703. Again, type on your calculator 15,000 into 81.4703. 12,22,055. To exchange fluctuation gain 3779. To trade receivable 12,18,276. Check the number, balancing figure, and then you write down one more entry. Exchange fluctuation gain account debit 3779 to P&L account 3779. Transfer of exchange fluctuation gain on monetary item. Trade receivable is a monetary item. Yes or no? Yes. Now we'll take a break.